Right now, over 70 million Americans have their retirement savings locked inside a 401k, and most of them have no idea that their money is sitting in one of the most dangerous positions it's ever been in. This isn't fear-mongering. This is math. And by the end of this video, you'll understand exactly what the warning signs are, and the 3 moves insiders are quietly making right now to protect their wealth. Let's start with the number most people ignore. The average 401k charges between 0.5 and 2% in annual fees. That sounds tiny, but run the math over 30 years, and a 1% fee difference costs you 28% of your final balance. On a 1,000 portfolio, that's £1,000. Gone. Transferred directly to Wall Street. Every single year. And that's before we talk about the market risk hiding inside your account. Open your 401k right now and look at what's inside. If you're in any S&P 500 index fund, which most people are, you're heavily concentrated in just 10 companies. Apple, Microsoft, Nvidia, Google, Amazon, Meta. These 10 stocks alone make up over 35% of the entire index. That's not diversification. That's a bet. And history tells us what happens to concentrated bets when the cycle turns. In 2000, tech-heavy portfolios lost 50%. In 2008, the S&P 500 dropped 57%. A portfolio that concentrated today would face similar losses, and your 401k would go with it. Now, here's the part that almost nobody talks about. Millions of people close to retirement were moved into bond funds for safety. Target date funds do this automatically. The theory is that bonds are stable as you approach retirement. But in 2022, bonds had their worst year in 45 years. The Bloomberg Aggregate Bond Index dropped 13%. Why? Because when interest rates rise, bond prices fall, and rates rose faster in 2022 than at any point in modern history. People within 5 years of retirement lost a combined 13 to 25% in their safe accounts. It happened once. It can happen again. So what are insiders doing? Not what they tell you to do. Here's what we're actually seeing. Number 1. Institutional money has been reducing U.S. equity exposure for 2 consecutive years. Major pension funds, managing retirement assets for teachers, firefighters, government workers, have been shifting toward international markets and real assets. They're not abandoning stocks. They're diversifying away from the concentration in U.S. tech. Number 2. Short-term treasuries and stable value funds are replacing traditional bond allocations. Smart money isn't sitting in long-duration bonds right now. They're parking in instruments that protect against rate volatility. Warren Buffett's billion cash position is sitting almost entirely in short-term treasuries. That's not an accident. Number 3, the wealthy are increasing exposure to inflation-resistant assets, commodities, international equities, and real estate investment trusts. These assets behave differently when U.S. stocks fall. That's called real diversification. 3 concrete steps you can take inside your existing 401k today. Step 1. Audit your fees. Log into your 401k portal. Find the expense ratio for every fund you're in. If any fund charges above 0.5%, switch to the lowest cost equivalent available in your plan. This single change can recover tens of thousands of dollars over a career. Step 2. Review your concentration. If more than 60% of your portfolio sits in U.S. large-cap stocks, you're overexposed. Most 401k plans offer international fund options. Shift 20 to 30% toward international developed markets or a total world fund. Step 3. Check your bond allocation. If you're within 10 years of retirement and sitting in a target date fund, look for a stable value fund option. Stable value funds are protected from interest rate swings in a way bond funds are not. These 3 steps won't make you immune to market losses. Nothing will. But they dramatically reduce your exposure to the specific scenarios that are building right now. Finance Alert. Global publishes weekly alerts tracking what smart money is doing, so you stay informed before the moves happen. Subscribe now, and share this video with anyone you know who has a 401k. Their retirement could depend on it.